All right, guys. Thank you. Pardon that big delay here. I've had some tech issues with this thing. I'm delighted to talk about our live stream today. Again, thank you for your patience. I really appreciate that. I'm just going to switch to screen sharing mode and going to pick this slide here. Let me see if this is going to work. Okay, one second. Yep. Okay. And I think this should work. Hold on, Mike. I apologize. I've had a lot of tech issues today, and for some reason, this thing is not letting me click back to the actual thing. Frankly, I'm not sure why. So I'm going to try to get this set back up. Nope. All right. Yeah. Anyway, so I apologize for this delay. I'm trying to set this thing up. I'm going to, oh, here we go. Okay. This should work now. Okay. So let me get started again here. I'm James Early, Chief Investment Officer of BBAE, and unfortunately, I'm not an IT guy, as you guys probably sensed. I'm back, though, from the Berkshire Hathaway annual meeting. I have been to every meeting since 2018. Two of them had to be virtual because of COVID. But this was a fantastic meeting. Unfortunately, it was the first meeting after the passing of Charlie Munger, Buffett's longtime partner of more than 60 years. He died about a month shy of his 100th birthday. However, it didn't really affect the crowd size. We had about 45,000 people, which is fairly typical. And it was just a great meeting. I'll explain a little bit more about the meeting in a second. But broadly speaking, these are just a few things that are what make Berkshire so special. 45,000 people. Charlie Munger and Warren Buffett are really the greatest investing duo of all time. And as I'll get to a little bit later, they're not replaceable. They may appear to be replaceable. And of course, as part of fulfilling their duty to their shareholders, Warren has, and Charlie previously had sort of built up this sort of roster of people to replace them, but you can't replace the irreplaceable. And I was reminded about that at this meeting. So we'll talk about that. We'll talk about what's in Berkshire's portfolio, courtesy of BBAE's Discover tool, which I'll talk about today. It's a great way to get insights into the portfolio of not just Warren Buffett, but quite a few other top investors, or just peek at different stock ideas. At BBAE, we want to bring you all kinds of ideas. We realize that's really the most important decision you make as an investor, at least on a month-to-month basis, is what stocks to buy. And we want to do our best to help you make that decision well and in an informed way. A lot of people, unfortunately, don't do that, and we want you to be a good investor. I'll share some takeaways, and then I'll do some Q&A. So, quick question, kind of a joke question, just to start us off. On a light note, what has been Berkshire's fastest appreciating investment? This is not actually, I think I can do a slideshow a little bit better here, a little bit larger font. I'm going to say it's Squishmallows. These came with the Jazzwares acquisition. These Squishmallows are all the rage. You can see some of the pictures here. They were $10 a Squishmallow last year for the Warren and Charlie Squishmallows, and now those guys are selling for $650 on eBay. This year we paid $14 each for Warren and Charlie. Actually, I ended up paying a little bit more because one of my friends went and bought 28 of them and then sold them for charity, which was a very good cause. I'd rather his charity get the money than some guy on eBay. The Squishmallows are just a sleeper, not even a sleeper hit. They're a hit. They had sort of a ball pit this year where you could jump into the Squishmallows, and some of the news anchors did that as well. So that's my joke starting question. So annual meeting, why is it so great? What's the cool thing about the Berkshire annual meeting? Why do 45,000 people come? Well, you get basically a solid half day, a little bit more of Q&A with Warren Buffett. You start out, he's got some prepared remarks. There's actually a video first, and this usually it's a funny video. This year it was basically a tribute to Charlie. It was a very touching tribute to Charlie, and they had recaps from many of Charlie's zinger quotes. Charlie is like Robin to Buffett's Batman. He comes in with the zingers, the one-liners at the end. And Warren calls him the architect of Berkshire. And we'll get to this in a little bit. But Charlie was a polymath. He was an architect, literally. Even though he wasn't trained as one, he designed buildings. He was a big fan of Ben Franklin. He was an attorney. He has a law firm, or formed a law firm that is still operating now, and an investment partnership. So they had a really good homage to Charlie. Nebraska Furniture Mart. This is a holding of Berkshire. They have a big sale every year. This weekend. Omaha, by the way, is 480,000 people, and it just gets descended on by this huge group of value investors, which totally overwhelms the tourist infrastructure. So it's kind of interesting. And rooms that might cost $140 a night suddenly cost $4,000 a night. I didn't pay that much, but it just gives you a sense of how this is. And there are just so many satellite events, breakfasts, dinners, get-togethers that are not part of the official Berkshire meeting, but still happen. But anyway, the main body of the main meeting is just Q&A from audience members. They ask Buffett, and used to be Munger, anything. Maybe 60% is kind of life advice these days. The rest is sort of investment philosophy / specific questions about specific investments. And they have no idea what questions they're going to get. And some people submit them over the internet as well. So, and one of the biggest, probably the biggest satellite event is the Markel annual brunch. The annual meeting is in a few weeks, and I'll actually be there giving you coverage from BBAE. There's a picture of the Markel meeting in the bottom quadrant or corner. What's the big deal about Berkshire? Why are we taking the time to talk about it? Like, what's so cool about this one company? Well, the most obvious answer is Berkshire has gotten 3.8 million% return since its inception in the 1960s. That's pretty darn good. And Warren Buffett is generally regarded as the best investor of all time. Well, okay, that's part of it. Actually, he considers Berkshire Hathaway proper to be his worst investment. And the reason is cognitive bias. He started buying this company in 1962. He decided this was a Massachusetts textile mill. And as I'm talking, I'm going to try to turn on the cooling fan on the back of my camera. Yep, I think I did that correctly. And he realized it wasn't a good investment. And about 2 years later, he started to want to get out. So he asked the owner, this Seabury Stanton, to make a deal. And he said, yeah, I'll sell you for stock for 11 4/8 or $11.50, basically. Back then, shares were quoted in fractions. And when the contract was actually papered up, Seabury had lowered the price just a little bit, 1/8 to 11 3/8. And Buffett just went crazy. And essentially for ego reasons, he decided instead of selling, he was going to buy the rest of this company and force Seabury out. And Seabury did quit. He saw the handwriting on the wall. Buffett said this was his biggest mistake ever. It cost him at least $200 billion because he was saddled with this, frankly, poor company that he later converted into a holding company, which we own. I own stock in as a Berkshire shareholder. So it's kind of a weird beginning, a big mistake, but it shows you that even Buffett has his vulnerabilities. Okay, Warren Buffett background. I'm assuming you know a little bit about him, so I'll be fairly quick. He is the sixth wealthiest person in the world, even after giving away $60 billion to charity. He went to UPenn and into Columbia Business School because he wanted to learn from Benjamin Graham, who was really, really famous at that time, made a lot of money. However, Graham was Jewish, and he had faced discrimination in the past. And so he was a professor, but also had his own investment firm. He made a policy to only hire Jewish people because he wanted to sort of combat or fight the discrimination they were facing on Wall Street at the time. And Buffett was not Jewish. So he went back to Omaha, worked for his dad's brokerage firm for a little bit, and basically just stayed on Graham. He pestered him for a job. And finally, after several years, Graham relented. Buffett worked for Graham for a couple of years, learning about net investing. The simple version is buying stocks that were trading below the cash value. That's like deep value. And the 1950s, where he was doing this, not just with Ben Graham, but also for the Buffett Partnership, which he started in 1956 after he left Graham, those were his best return years. The net were great. Now, he couldn't do that forever. because guess what? Everybody found out about net nets too. And when everybody on Wall Street finds out about a strategy, that chases the returns out of the strategy. But for a good while, it worked. And it's basically the reason he has such great returns is those net nets. And then from 1970 on, he just started to use Berkshire Hathaway as his main vehicle. And by the way, this is me standing in front of his house in the lower right corner here. You can see, I'm sure they're not wild about visitors, but they get a lot of them. They get a lot of them the annual meeting weekend. People basically just do photos and leave. Sometimes you'll see a media outfit just stalking him, like waiting to wait all day long. Sooner or later, he's going to come in or come out. But I was just there for 5 minutes. Okay, so Charlie Munger, as I mentioned, the architect, and you guys can probably read this on the screen, architect of Berkshire Hathaway, in the sense that Charlie convinced Buffett that the deep value investing that Buffett was pursuing was not going to work ongoingly. Berkshire had gotten too big for that, and it was okay to pay up for a better quality company. And See's Candies, that was the first company that Buffett really paid more for, and it worked out very well. So Charlie, in many ways, did totally change the future of Berkshire Hathaway, and Warren thanked him for that. He went to law school, did very, very well, started a law firm, had his own partnership that grew at just about, is 19.8% per year, just about 20% from 62 to 75. And he joined Berkshire in 1978. As I mentioned earlier, unfortunately, he passed away just about a month shy of his 100th birthday. And it was just really amazing watching these two guys on stage. Buffett is 93. Charlie was 99. They have they're aging. You can see that, but they're sharp. And to me, it shows you that if you do something you love with people you care about and you connect with, I think it helps you to live longer. Now, this is anecdotal, but I think it was true in their case. They really had found their passion. They were good at it. And they take questions for hours from everybody. And that's pretty amazing to do at that age. So they deserve a lot of credit. They are investing icons, not just who have inspired Berkshire investors directly, but really a whole generation, or maybe 2 generations by now, of value or high quality investors. That's their shtick. Okay, they look for good companies, good management teams, cash flow. They've been doing tech a little more lately, thanks to some lieutenants, but they're more, tried and true investors at heart. So let's see how we can use BBAE's Discover tool to find out about what's in the Berkshire Hathaway portfolio. Okay, a few considerations or caveats first. Berkshire Hathaway is not just a publicly traded stock portfolio. It does have those. It's about 60% of the value, roughly. But they've also got a lot of private businesses, most of which they wholly own. Now, for the public companies, they own minority stakes generally, but for the private companies, most of them they own entirely. You can see Scott's Fertilizer, Justin Boots. They own the Pilot gas station truck stop company. There was a big lawsuit about that recently. The Jazzwares, that's the Squishmallows company. I think that was a little more successful than they expected it to be. See's Candies, of course. This is a Guru Focus chart just showing some of the public holdings. Apple has basically been about half. Now, they've just sold that a bit. They sold 13% off, which is, just a relatively small amount. I think they're going to sell more. I'll talk about that later. But Bank of America, you can see American Express, Coke. They got a little Amazon. I'm trying to think what else. They got you can see Chevron, been buying some oil recently, Kraft Heinz. So pretty well diversified, except for Apple. I think having half of your public holdings in one stock is not diversified. Todd Combs and Ted Weschler convinced Buffett to buy Apple in 2016. These are some relatively younger lieutenants who came in and started advising him on tech. And because otherwise he wouldn't know about it. He famously avoided tech, although it did hurt him in the late 90s, but not as much as you might think. He still did amazingly well, and I think underperformed for just 1 or 2 years. Okay, so how do we put all this stuff in the framework of how to value Berkshire? Well, there's no official way. Nobody knows. It's a market price kind of a thing, right? So it's whatever the market will bear. Well, my friend Whitney Tilson is he is the #1 expert, I believe, in the world on Berkshire Hathaway. His former partner, Glenn Tung, is also a close contender. These guys have both met Buffett and Munger personally. Whitney contributed a chapter to Poor Charlie's Almanac, a book about Charlie Munger's wisdom, has a lot of speeches he gave. So Whitney's guess, in my opinion, is about as good as any. So Berkshire has 2 shares, Class A and Class B. Whitney basically says $404,000 in cash for Class A shares. And then for the private companies, he values them at a multiple of their operating earnings. So he says almost $22,000 per Class A share in pre-tax earnings from those privately held companies. He assigns an 11x multiple. He thinks that's a fair-ish multiple, maybe slightly conservative for that number. We're not talking about net earnings or net profit. We're talking about operating earnings, okay? So you might have a little bit lower multiple. The S&P average PE on net profit is about 15 or 16 over time. So this is a little bit upstream of that, and that's why the multiple is a little bit lower. And so he gets this number of $656,000 per A share, $437 per B share. It's a little bit, means the stock right now will be a little bit underpriced by Whitney's model. Now, I'm just sharing Whitney's model. I'm not endorsing it. BBAE is not endorsing it. I'm just showing you one way that I think is probably a reasonable enough way to go about valuing the shares. But it's by no means the only way, and I'm not saying it's the correct way. So again, it's not any kind of recommendation. Okay, it's just what Whitney does. These are 2 charts, though. Here's another consideration before we open up Discover. So on the left, this is Berkshire's long-term performance. This is the A shares going back to, I don't even know if this is the full history, but this is much of the history back to the 1970s. And you can barely see the S&P 500, the green line, right? Over the past, 20 something from 2000 to present. Okay, so 24 years. It certainly still outperformed the S&P, but you can see it's outperformed by less. Berkshire is a victim of its own success. It's gotten so big that it's hard to put on a lot of profitable investment positions without overly moving the market. And that's just the way it is. So A, they've gotten big, and B, they've inspired a lot of copycat money of similar investors who want to buy Berkshire-esque kind of shares. So Buffett is very conservative and always says we won't perform as well in the future as we did in the past. And broadly, that's true, but the stock has still outperformed the S&P. So anyway, here we go. I'm going to show you a quick little recap, perhaps with a little narration, of how we can use BBAE's Discover to find what's in Berkshire's portfolio. And I'm just going to give you a little tour of Discover generally in the process. So here we are. Again, pardon this. So Filing Genius is one thing we've got in Discover. You can see here, it's based on ChatGPT. You can ask Discover questions about certain things, and it'll spit out the answer to different SEC filing questions. We have a feature called Town Square, where you can go in and see how certain investors are doing. And you can click and see 3-month returns, 6 months. Here's 12-month returns for some of these people. And if you want to, you can copy their trades. You don't have to. It's just an idea. We've got proprietary content. I'm on there, and so are all other people. Here's an example of insider edge content. This is just one example. This guy goes in and takes a look at insider sales, and he shows you the historical returns of the insider, like who's doing it and how good has that insider been. Because if you've looked at academic research, you know that insiders do surprisingly well. So besides this, we've got some sort of standard data, I would say, on different things. We've got earnings calendars, dividend calendars. We've got news in Discover. But for right now, we're going to go to these curated investment themes. Now, you can see here, I'm going to scroll down. We've got all kinds. We got portfolios of many of the most famous investors in the world. Then we've got portfolios done by sector or industry, financials. You can see insurance, banks, asset management, and some regional groups of stocks, consumer goods. But you can take a look here at airlines. See some of the winners here over the past year. SkyWest, wow, and then some of the losers. So we're not saying to buy or not buy any of these stocks. These are just starting points for ideas. Now I'm going to scroll back up to Berkshire Hathaway back at the very top, and you can see how this works. So I'm going to set this to 1-year returns, and these are the stocks in Berkshire Hathaway's publicly held equity portfolio. So we can just scroll down. We got Moody's, NVR Homes, Visa, and MasterCard. Those are both good companies. In fact, there are more than that, but you can click more to see them. But the point is, Discover gives you essentially an instant snapshot into the portfolios of many of the best investors, or at least top or best regarded investors, very famous professional investors. It's hard to say who's best, right? Because you can get good returns for different lengths of time, but certainly many of those investors that are regarded by the public as being very good. Okay, so let me scroll to the next guy here. Okay, so here I'm going to dig into a few of these shares. So, and share with you what I learned. So I took a couple of screenshots because I think it's a little bit easier to see in a still frame here. So Liberty Media, this is a company that caught my attention because I've never really focused too much on it. They used to own the Atlanta Braves. They own Discovery Channel, outdoor advertising, radio advertising, Formula One, some of Sirius XM. This is a big conglomerate. And frankly, I've never been familiar with it. And the thing that stuck out to me when I looked at Discover is 1, 2, 3, 4, 5, 6. Look at all these different classes of Liberty Media shares, okay, that Buffett owns. So it's quite a lot. So I'm going to check into that more. I know I got to move along on this webinar, but like that's an example of something that caught my attention. Okay, I just didn't realize that he liked it enough to buy so many different versions of the same share. Apple is another one. You can see the screen here, and you can always click to trade any of these stocks on BBAE if you want to. You can also access some research. So Apple has been turning down a little bit, some troubles in China as of late, as many of us know, and that is certainly a big market. Buffett sold 13%, as I mentioned, and you can see here. I think he's not done. Just by his wording, I think he's not done. I think he's polite because Tim Cook, CEO of Apple, was in the audience. So it's a little bit awkward hearing him talk about unloading a very major stake of what has been Buffett's and perhaps the world's biggest gaining investment of all time, not on a percentage basis, but on just a sheer volume, the billions of dollars that Berkshire has made in Apple. It's been huge. It's been huge. So he's unloaded some already. I expect more. Diageo is another company that personally I've liked, and I don't own shares right now, but I have owned shares in the past, and I may own shares again. I do own shares of Apple, I should say. I don't own Liberty Media, obviously. Now, Diageo is an alcohol company based in the UK. They make premium alcohols, and it's kind of a global play because in a lot of countries, especially the emerging markets, Middle East, Asia, and some parts of Africa, these sort of cheap, accessible luxury items like expensive alcohol that you might buy for a business colleague or buy for a business dinner, these are status symbols. And you know, the drinking rates, for better or for worse, have gone up a lot among a lot of these emerging markets as they can start to afford alcohol. And the growth rate of the super premium segments that Diageo sells has been more than twice, if I recall correctly, the global average alcohol growth rate average. So in other words, alcohol generally has seen some growth, but the super premium segment has done particularly well. So that's exactly what Diageo does. They don't do any, Budweiser commodity kind of beer, just high-end stuff. So it's not too surprising that Buffett owns it. This is the kind of company that would have a very big moat, a high ROIC, and Diageo's was in the high teens to low 20s last time I checked. That means they're earning quite a lot of money on their invested capital, whether that's money from debt or equity. And it means that all the competitors, Diageo's been around for a long time, more than 100 years, all the competitors have not been able to chip away at that moat. Okay, that's what you want. That's a good company. So it's not surprising that Buffett owns Diageo. Okay, I think I missed one. No, okay. So some meeting takeaways, and then I will jump to the Q&A. As I just said, I think we're going to see more selling of Apple. I think we're not done yet. The biggest thing, though, for me was I think there's been some drama behind the scenes in the investment committee or in the investing ranks at Berkshire, because Todd Combs and Ted Weschler were these wonder kids were pitched as the upcoming co-CIOs. And with Charlie, unfortunately, having passed away, I thought we're going to see more spotlight given to, first of all, Greg Abel, who runs BHE Energy. He's also going to be the main asset allocation successor of Buffett. which is a pretty big role for an operating guy, whereas Ted and Todd are, dyed-in-the-wool investors. But Buffett seems to trust Greg the most, I guess, and that was interesting. It seemed like he kind of downgraded Ted and Todd a little bit. So that's one thing that stood out to me. But the thing is, Ajit Jain, who runs the insurance business, and Greg Abel, they're very, very smart people. I don't think they have anywhere near the personality to fill a 45,000 room seat arena. Not even close. An example of that at the meeting, some lady from Nevada asked, why doesn't Berkshire Hathaway's energy unit in Nevada have more solar? Greg Abel gave the most forgettable corporate speak answer possible. I don't remember anything about it. And then Buffett realized, hey, I better say something. So he said, well, we'd love to have more solar, especially in Nevada, but the sun doesn't shine at night. And so we got to have some other fossil fuels, at least for now. And that was the crowd pleasing answer. So anyway, these guys may be good, but they're not personalities. You can't replace the irreplaceable. So I think, unfortunately, when Warren has departed, we're just not going to see the same thing we've seen at Berkshire. Insurance did pretty well. That really sort of carried the company. Geico has been behind its peers on IT, and they got questions about that this year. But even with that, they did well. Now, railroads did not do so well. Some legal issues there, and BHE definitely had some legal issues. One of their companies is called Pacific Corp, and a couple of years ago, Pacific Corp had some wildfires happen in Oregon, and they got sued for negligence. They say, no, it's not our negligence, it's global warming, and we should not be held accountable. And they're appealing. There was a $30 billion verdict they're supposed to pay. And Buffett is usually reserved about criticizing any aspect of the U.S. government. He's very pro-U.S., but he was fairly aggressive about criticizing this ruling. He thinks it's not fair. He thinks what it's effectively doing is making the utilities like Pacific Corp de facto insurers against global warming. And he thinks that doesn't make sense. And it might be necessary then to not privatize, but sort of publicize, make them go public, because that's the only way they can get capital in this industry. In other words, if the regulators are so iron-fisted and so aggressive about forcing these liabilities, which Buffett says are from global warming, onto the insurance companies, onto the utility companies, that makes utility just less of a desirable business. Why would you want to get into it? Like California did that years ago, right? They regulated so much that their utility went bankrupt. And now they learned their lesson. The ratepayers, the average people, don't want to pay high rates, and it's easy to blame this big corporate utility. It basically has a monopoly, this bad guy keeping rates high. But sometimes not the case. They go bankrupt too. And Buffett is worried about that. And if Pacific Corp loses, we could see Buffett maybe pulling some money out of utilities. Pacific Corp is one of his private wholly owned companies. And it could not just be Buffett. It could be a lot more people. So I think what's at stake, I think the media is actually underplaying it a little bit. I think the future of investing in U.S. utilities is at least a little bit connected to what's going on here in this drama. So with that said, we are most of the way into this live stream. I'm happy to stop now and take a little Q&A if anybody has questions. Let me shift over to this chat. All right. Okay. So I don't see any questions. I am going to be here for a few more minutes in case we do get questions. Let me just open up my YouTube and sign on here. There's my cell, just to make sure I can see everything. So I'm just going to say hi. And all right. So if I get any questions, I'm happy to take them. If not. But thank you guys for watching. I certainly appreciate it. And next year, actually even before next year's Berkshire, we'll be going to Markel, which is a baby Berkshire. Many people call it that, a baby Berkshire. Berkshire used to own shares of Markel, and they recently sold it. But I've had the privilege of speaking with CEO Tom Gaynor. He's a very, very nice guy, very down to earth, humble, principled person. And like Berkshire, it's an insurance company that uses its float money to invest. in the old days, insurance companies would have this float, which is the money they sort of sit on in between when somebody pays the premium and then they have to pay out a claim. And most insurance companies, I should say, would traditionally invest that float very conservatively. Berkshire, though, broke the mold and put that float into stocks. And that's one reason that Berkshire has been such an impressive investment. Warren Buffett really figured out that he could pair insurance and investing. That's sort of like peanut butter and chocolate. Those businesses go very well together. And Markel is doing roughly the same thing. And so please stay tuned for our Markel coverage from Richmond, Virginia, when that happens too. So let me see. I believe probably a good time to wrap up. I'll wait another minute or two for questions. Hopefully everybody got something in this for you, depending on what you're wondering about. And happy to, even if you watch this replay later on, happy to respond in a blog or in a weekly video with answers to any questions we get from viewers that don't have a chance to watch this event live. So any questions, whether you're watching this live or later on, just drop them in the chat and I'm happy to answer them. So, all right, guys. Well, listen, thank you very much. Looks like that's what we got. So I'll wrap it up here. I wore my BBAE shirt. I hope you guys like that. Again, any questions, just let us know. Happy to, and any feedback, any thoughts on what you'd like to know, not just Berkshire, but information about any other investors or ways of investing. We make content for you. It's very important to us to make relevant content. So let us know what can help you best. And I'll see you in the next video, the next live stream, the next article, whatever it is that you watch. So thanks so much, guys, for being here. And we'll see you soon.